Hey, everybody, thank you so much for joining the Think Realty podcast today. It's our pleasure to come to you, bring you some great guests. As we jump into the podcast, I want to say a quick thank you to our podcast sponsor. Our podcast sponsor is Rent to Retirement. Does 20% return on investing turnkey rental sound attractive to you? If it does, then you can go to Rent to Retirement. They offer fully turnkey properties that are newly built or renovated, leased and managed, allowing you to invest with confidence out of state. Rent to Retirement helps investors build a business plan to achieve financial freedom. To learn more, go to renttoretirement.com. That's renttoretirement.com. As always, we bring you some fascinating guests, some guests that are innovative, that'll help you in your investing journey. Many of you are on this path. You're trying to figure out what's going on in the economy right now, and so we've got a great guest that I think will help you along the way. So today, our guest is Michael Ramin. Michael is the Senior Vice President at Sharestates. I think, Michael, you said you're one of the first original 4 in the company. Is that accurate?
Yes, that's accurate. The original 3 founders, and I was the 4th person to join the company.
That's great. That's great. Well, you guys, I mean, from my vantage point, have had just massive growth over the past few years. If you don't mind, kind of tell our audience what Sharestates does and talk about, the growth you guys have had in the last 3 or 4 years.
Yeah, of course. So to give you a little background, it's actually almost Sharestates' 10-year anniversary.
Wow.
When we launched Sharestates, Sharestates was originally an equity real estate crowdfunding platform. And our investors loved the idea, the concept, and everything, but they preferred to be on the debt side. So we converted it from an equity platform for a debt platform, and we started actually syndicating debt online. We grew the platform from there. And as origination scaled, we had to figure out another way outside of using our platform to raise funds for clients for fix and flips and other projects. So Sharestates went the institutional route, and we brought on institutional investors to kind of complement our platform investors, which we still work with today. And we kind of grew the platform from there. Originally, Sharestates was a fix and flip platform. So borrowers came on and they got financing for fix and flip projects, whether it was like a single family home or 2 to 4. And as time went on, we wanted to graduate with our investors. So a lot of investors came on with experience, and they started 1 to 4 family homes, and just natural progression, they either went into ground up from there because they found better opportunities to ground up, heavy rehab, and all that, or the other progression was to go into multifamily. So they started looking into 5+ unit properties or getting into mixed use. So as our borrowers kind of scaled their business, we scaled ours to be able to keep up with them. And we added on different products within the mix. So we started in the fix and flip space. We got into ground up and heavy rehab where people were adding on dormers or extensions to the properties. And then we got into multifamily and mixed use. Several years into that, we had a borrower that we worked with several times that enjoyed being, he saw, I guess, the vision first in the industrial space, so office, retail, warehouse. And we started working on that end as well. And we did our first loan on industrial property and added that on as a product as well. And then several years ago, probably a year before the pandemic hit, we started in the DSCR rental space, and that grew pretty rapidly. And similar to like the sponsor you mentioned earlier, like the Rent to Retirement, where borrowers would come in, they would buy a home, fix it, and then instead of selling it and flipping it, they would rent it out and they would create cash flow, whether it was for themselves or for future generations in their family. So it's pretty
That's
cool.
Great. It's awesome. Awesome model. How many states do you guys currently lend in?
Right now, we're in 44 states.
44 states. Wow.
We originally started on the East Coast, and we expanded, and then we added on certain licensing for states that we found important to our business, which is California and Arizona, which require a commercial lending license.
Sure. Yeah. Very good. And so the mix of what you're lending on, are you still really heavy in fix and flip, or are you doing a lot more long term or bridge, or what's kind of your product mix and what you're lending on today?
Yeah, absolutely. Right now, you're still seeing a lot of the fix and flip, but we've seen an uptick in ground up and small multifamily. So anywhere in that 5 to 20 unit range. We've seen a lot of requests for that come in recently. Usually poor old, either old management, so old owners that are looking to sell, or mismanaged properties where borrowers are finding an opportunity to rehab the property, raise rents, and refinance the properties out, especially with either shortage of housing, which the market is calling for right now, or having a product where people can come in. It's a kind of like it's ready. It's a good quality asset where they can live and have like a price point where they're comfortable with.
Yeah, you make a great point. That some of the stats I've read recently say that we're somewhere between 5 and 6 million homes underbuilt in the United States right now. That we just have this massive need for more inventory in the marketplace that is both affordable, and available. Let me just ask you this as we kind of like jump into. I think the audience now knows who you are and what you guys do. I think on the mind of every real estate investor now is money, right? Interest rates are rising. The loan marketplace is shifting a little bit. Underwriting guidelines have shifted. What are some of the big changes that you are seeing on the horizon for the lending landscape? Maybe for Sharestates or for other lenders as a whole.
I think in the industry in general, I think you've seen a lot less liquidity, and you've seen an update to terms and rates. So you've seen rates maybe earlier this year. So I would say January, February, rates were as low as maybe 7%, 7.5% on fix and flip and bridge products within the institutional world to the end borrower. Today, you'll see those rates higher. You'll see them anywhere from like 9.5% all the way up to 12, 13%. So you've definitely seen an adjustment there. I think where you see another adjustment is on leverage and ARV. A lot of lenders were up to like an 80% on ARV. You've seen that drop down to anywhere back to like 65 to 75%, depending on the asset type. So the post valuation has definitely dropped as well. And you see upfront leverage. You were seeing 90% loan to cost on a lot of products. So you're seeing that down like 5% on all ends as well. Seen it from almost all lenders. I think it's just something to kind of curb the risk. If you see that prices are falling or demand is falling, they want to make sure with higher interest rates that there will be an exit. The prices don't drop too much where the investors aren't secure. So you definitely see that.
Yeah, that's it's interesting. I think it obviously is a moving target right now, and so important for you to find a partner in a lender, if you're a real estate investor, that you can trust and you can navigate these waters with, right? Because and get things locked in now, because you really just don't know where the market's headed, what the changes are going to be, and it's so important to not look at a lender and just shop from lender to lender to lender to lender. It's important to find relationships in the lending space, especially private lending, so that you can kind of adjust with that partner. As far as the ground up new construction, the product you're talking about there, I know a lot of our bigger rehabbers have moved into new construction. We've seen a big shift in the Think Realty base of 10 to 20% of our audience moving into new construction. What does a new construction product look like for you guys, and what does that look like for them to inquire about that with Sharestates?
New construction right now, definitely very popular. So it can be different in many products because we don't just do single family homes. So we do single family homes. You can do subdivisions. So a lot of borrowers come in. They bought property maybe a year ago. We work on subdivisions. They got entitlements. Now they have separate lots. And now they're coming to get a construction loan maybe on 10 lots at once. And then we also do it on multifamily properties as well. Usually want to see a borrower with good experience, so prior ground up experience as the sponsor themselves. But depending on where they are in the plan approval phase, they'll get them up to 50 to 70% of like the land value up front and up to 100% of their hard cost on the loan itself. And then rate wise, it's adjusting day to day. So it's tough to say like where the rates will fall in today, especially with volatility. And I think there's another Fed hike today, which will affect the institutional world a little bit, and conventional loans where the rates will fall in there. But right. You're usually getting up to 85% loan to cost still on single family, 1 to 4 family ground ups, and up to 80% loan to cost on multifamily. Very experienced borrowers will even go higher. So yeah, experienced borrowers and repeat borrowers tend to get better terms. It's just that you've seen the progression over the years. So You've seen borrowers come in, you've seen how they borrow, the types of properties they buy. You've seen their draws, how they're paying off or paying, refinancing the loans or selling them. So it definitely works well when you have a repeat borrower.
That's great. A lot of our audience varies in experience. That we've got a lot of mom and pop landlords that have 5 rental properties. We have big developers. We're kind of all over the place with the Think Realty audience. But what's one piece of advice you might give somebody that is navigating investing today? I know many of them are sitting and waiting. Some of them are trying to get liquid. Some of them are doubling down and trying to find new opportunities. Some of them are shifting, asset classes. What's one piece of advice that you might share with a real estate investor that's navigating the current economic situation we're in?
Yeah, great piece of advice. I always like to give people, rates are always going to fluctuate. So I wouldn't be, everyone's always going to be rate sensitive and you want to make the most money on your deal. But if your debt's like on a rental property, the rates have gone up. You were at 3.5 to 4.5% earlier this year. Now you're seeing anywhere from 6% all the way to 8% on, a DSCR rental program. If your DSCR is hitting, I usually like to tell people, say, hey, lock down the financing. You're able to get the cash out. You'll have either anywhere right now, they have rental programs from 1-year prepay to 5-year prepay. Get the loan. This way, if you're at least hitting your numbers that you're projected, you might not have as high as a DSCR as you wanted, but your numbers still work. If they still work, you get your financing and you're able to buy more properties. So I always tell them, it's good to look at a rate and get a great rate, but at the end of the day, if your numbers work, it makes sense. Same thing with a flip. If someone's flipping a property, I know in the last couple of years, everyone got accustomed to paying 7 to 9% on their fix and flip rates. It's a little bit higher now, but if you see the spread there and you're getting a good deal, to worry about the rate on a 1-year loan, you have 2% difference. If you finish the property in 6 months, it cuts that 2% down to 1%, and you're still making your spread on the property that you projected. So I think it's great to shop rates and all that, but in a volatile market, if you know the area well that you're buying in, you've worked there before and you're still seeing that sales are doing well or rentals are doing well, if you can find the financing, you get it now and you have the opportunity to refinance, whether it's in 1, 2, 5 years, and hopefully into a better rate at that time and either cash out to buy more properties or just, increase your cash flow with a lower rate.
Yeah, that's great advice. And for maybe the newer real estate investor, DSCR is debt service coverage ratio, which really deals with, can your renter or the person that's essentially paying you for the asset, will that debt service, will it be covered by the rental unit itself or the rental income? And that's what he's speaking about. And every lender has their equation of what they feel comfortable with from a DSCR loan. Michael, I appreciate the time today. How can they get in touch with you or Sharestates if they're interested in finding out more?
Absolutely. I can always be emailed at michael@sharestates.com. You can also go to www.sharestates.com, create a profile. You're able to use our platform to submit loans, to submitting documents, the whole process all the way to closing and your draws. So we're very big on the technology on that aspect. And we're always available. So you can always call the office itself and reach out to somebody, email. And once you get in touch with us, you can, a lot of our team does work on text, email, Microsoft Teams. We try to make ourselves as available as possible to make sure we get you funded in time.
Very good. Thank you so much for being with us on the podcast today. It was informative and helpful, and I would encourage all the Think Realty viewers to go check out Sharestates. They've been a staple in our industry for, like you said, 10 years now. Congratulations on 10 years. That's a great milestone, and a very innovative lender that obviously he said lends in 44 states, and you owe it to yourself to check out what they have. So thanks, Michael, for being a part of the podcast today.
Thank you, Eddie. Thank you for having us.
Absolutely. Our podcast sponsor is Rent to Retirement. Does 20% return on investing turnkey rentals sound attractive to you? If it does, then you can go to Rent to Retirement. They offer fully turnkey properties that are newly built or renovated, leased and managed, allowing you to invest with confidence out of state. Rent to Retirement helps investors build a business plan to achieve financial freedom. To learn more, go to renttoretirement.com. That's renttoretirement.com. If you haven't started making plans for next year, the Think Realty Conference and Expo in Houston takes place on March 23rd and 24th. Set your sights on making 2023 a success. with more knowledge and know-how in the real estate space. Thank you so much for watching the podcast today, listening, downloading, participating. Go to your local Barnes & Noble, pick up the latest magazine, or subscribe. We would love to hear more feedback from you as the real estate investor that's boots on the ground today. So continue to engage with us on social media. We're everywhere that's social media that you connect with, and we'd love to hear from you. Thank you so much today for watching and viewing. We commend you for engaging and continuing the journey of your real estate investing career. Please let us know how we can serve you better. We look forward to hearing from you. Take care and happy investing.